Let's be real for a second. Does investing ever feel like a game that's just rigged? You watch the charts, you make your moves, but at the end of the day, it feels like you're just not getting ahead. Well, you are definitely not alone. So today, we're going to dig into why it feels that way and how a timeless classic, The Intelligent Investor, shows us how to win what really can feel like a loser's game.
I mean, this picture just says it all, right? The kind of fast-paced trading that modern apps encourage, it really is like sprinting on a treadmill. You've got all this motion, all this excitement, but when you look back, you haven't actually gone anywhere. You're just running in place.
But what if this whole frantic, exhausting race isn't the only way? What if there's a completely different approach to the market? One that doesn't demand you be the fastest runner, but maybe just the smartest walker. That's the big question we're tackling.
Okay, so to figure out the solution, we've got to understand the problem first. And the problem is, for a lot of people, investing has been twisted into something that looks a whole lot less like building wealth and a whole lot more like a night at the casino.
Just look at these features. I bet they look familiar. Modern brokerage apps use all the tricks from the gambling playbook. You've got bright, flashy displays like a slot machine, digital scratch-off tickets for rewards, and constant alerts pushing you, goading you to make another trade. They even add leaderboards and social features, so you're focused on beating other people instead of just reaching your own goals. Make no mistake, this isn't investing, it's gamification.
And here is the brutal result of that game. A study looked at the most active day traders in Brazil and found that fewer than 3% of them actually made any money. That means a staggering 97% lost. When you play that fast trading game, the odds are just overwhelmingly stacked against you.
So here's the crucial part. The stock market, by its very nature, is supposed to be a positive-sum game. Over time, as great companies grow and create real value, the investors as a whole build wealth together. But the moment you start trading like a maniac, you introduce costs and taxes, and you make yourself way more likely to buy high and sell low out of panic. You literally take a system designed for winning and turn it into a game where almost everybody loses.
And this brings us to the absolute core choice in Benjamin Graham's philosophy. It's a choice every single person has to make before they put $1 in the market. Are you going to be an investor, or are you going to be a speculator?
This chart just lays it out perfectly. On the left, the investor. They act like a business owner. They're analyzing a company's real underlying value, its ability to generate cash over the long haul. But the speculator on the right, they honestly don't care about the business. They are just betting, gambling, that they can flip their stock to someone else for a higher price, and soon. It's a bet on price movement, not on actual value. And this realization completely changes how you should define risk. For Graham, risk isn't that your stock goes down for a little while. That's just noise. It's fluctuation. Real risk, true risk, is the chance of a permanent loss of your money. Your capital is gone, for good, either because you paid a ridiculous price or the business you bought into actually fell apart. It's such a simple but profound shift in thinking.
So, if we want to dodge the casino and all that speculation, what's the alternative? Well, let's meet the hero of our story, Graham's blueprint for a sane, successful approach, called the defensive investor.
I absolutely love this quote because it gets right to the point. The goal isn't to become some Wall Street whiz kid or make the absolute most money possible. No, the goal is to get a good, satisfactory return while minimizing your own stress and worry. Think about that. Freedom from concern. I mean, what an incredible goal to shoot for.
So how do you actually do it? Well, Graham lays out 4 beautifully simple rules. First, diversify. Don't let one bad company sink your whole portfolio. Second, stick to quality, large, well-known companies that are financially sound. No risky moonshots. Third, look for a long history of paying dividends. That's a great sign of a healthy, real business. And finally, number 4, don't overpay. This last one is key. It's designed to keep you far away from the hype and speculation around so-called growth stocks.
Now, following those rules is a great start, but there's a tool that makes this whole strategy almost automatic. It takes your emotions and all the guesswork right out of the equation. It's the power of putting it on autopilot.
And that tool is called dollar cost averaging. And honestly, it's as simple as it sounds. You just commit to investing a fixed amount of money, let's say $100, at a regular time, like every month, no matter what. You don't try to time the market, you don't try to guess if it's high or low, you just automate it and let it run.
So let's play this out. The market hits a new all-time high. Everyone's going crazy. What do? Nothing. Your automatic $100 investment just goes in like clockwork.
Now the market crashes. Panic is everywhere. Your friends are selling everything. And you? Your $100?
It just gets invested, same as always. You see, the goal is to remove you from the equation. Your fear, your greed, all of it. The simple, boring, relentless discipline of just continuing to invest, that is the secret to winning over the long run. And here's the simple magic behind it. In Graham's own words from 1962, when prices are low, your fixed dollar amount automatically buys more shares. When prices are high, that same amount buys fewer shares. So without any special genius on your part, you naturally end up buying more of your assets when they're on sale. It's just brilliant. Okay, so we have the rules and we have the tool, but there's one last battle we have to win. And honestly, it's the hardest one of all. It's the battle against our own psychology and the infectious emotions of the crowd. You see, crowds can be incredibly wise, or they can be completely mad. The wisdom of crowds comes when you average a bunch of independent guesses, like when people accurately guess the weight of an ox. But the madness of crowds happens when we stop thinking for ourselves and get swept up in emotional contagion, like with meme stock frenzies. The key difference there is independence versus influence.
So, how do you protect yourself? You have to vaccinate your mind. Steer clear of all the hot takes and shouting on social media. Avoid those online communities that are just built on anger and boasting. One of the best tips ever is this: write down your reasons for buying something before you actually do it. It forces you to be rational. And always, always remember, on the internet, likes and upvotes go to the loudest advice, not necessarily the best advice.
And this all leads to what might be the single most important lesson from The Intelligent Investor. In the end, your success as an investor won't be determined by your IQ, it's going to be determined by your temperament. Your ability to control your emotions, to stay disciplined when everyone else is either panicking or getting greedy, that's your greatest asset. And so we end right back where we started, with that one fundamental choice. After everything we've looked at, the casino apps, the discipline of the defensive investor, the madness of the crowd, the question is back on you. Are you playing a speculator's game, or are you building wealth like an investor? The choice is yours.